Hi, this is Rick Durfee and Daniel Hansen with Durfee Law Group. And we're going to talk for a few minutes here about the Augusta Rule, a rule that came out of the Masters Golf Tournament in Augusta, Georgia, on home rentals. And it's a little known and poorly used part of the tax code that can actually provide some significant benefits both to homeowners and even more so if the homeowner is also a business owner. So Daniel, why don't you summarize that rule for us and tell us what it is basically?
Yeah, so what it is a rule that allows you to rent out your home for up to 14 days, and you do not have to claim that income on your 1040 or really anywhere.
So you get paid for somebody to use your house for up to 14 days, and it's not income. You're not taxed on it.
Exactly.
So tax-free money.
Mm-hmm.
That's kind of cool. Now there's some rules, right?
Yeah.
It has to actually be rented.
Yes.
Can't be a fake thing, so people need to come and use it.
Yep.
And you need to keep a record of that. And
well as a record on your expenses for it too.
When you're reporting it.
Mm-hmm.
When you say the expenses, when you're the business owner and you're paying that rent, is that what you mean?
Not just the business owner. If you are a person renting out the home, you are supposed to track the expenses of renting it out.
Ah. So if you had to pay a cleaning person to come in and or trash, or I don't know, buy coasters to keep your table from getting ruined by the drinks, you
Yes.
report all that.
You're supposed to have that as expenses, and that goes in
Okay.
the reporting.
Okay. Now this can work if you are the homeowner and you own a business. Your business can rent your home from you for up to 14 days.
Yes.
But now my understanding is, again, there has to be a business purpose.
Behind the business, yes.
So you can't just say, oh, I just want to do it for fun. Let me pay 14 days for the rent. There has to be an actual business activity.
Has to be a legitimate business, which is loosely defined by the IRS.
So it's my understanding is that it can't be a pass-through entity or a disregarded entity like a sole proprietorship or even a single member LLC. It's got to be either a partnership or an S corp or a C corp.
It can be a disregarded entity, so it can be an LLC.
Well, it can be an LLC, but only if it's taxed as SC or partnership. Am I wrong there?
It can be a disregarded entity.
Wow. Okay.
Now there's so there are people out there who have written that it should be an S corp or it should be a C corp. It should be something other than that, because their fear is that it doesn't pass this rigorous business test that they've said you need for the IRS. However, the IRS is actually pretty simple on what they've stated is the requirements for a business entity.
So now, if it's a regular business entity like the C or an S or a partnership, that business entity is going to issue a 1099 for the rent.
Correct.
If it's more than the $600 limit. So how do you do that if it's a sole proprietorship or disregarded entity?
Well, the idea is you don't actually have to issue that because you don't have to report the income.
Okay, cool. So you just take the rent and it's not income.
Exactly.
Interesting. But again, it's got to be documented.
Yes, you need to document it in case you're audited and you need to show proof of that.
Now, I want to understand this relationship between the 1099 and the homeowner. So if anybody's business, whether it's yours or anybody else's, rents your home for these 14 days, and it's more than the $600 minimum, they're going to give you a 1099 for that.
They should, yes.
And so you get that 1099, should you report that on your taxes?
You need to, otherwise you will get an automatically generated computer audit.
Right, so you got a 1099, you didn't report, automatic audit. So you report the 1099. How then do you disappear the income?
So you're going to expense it out.
Okay.
And again, the way that this is traditionally done is, say you're renting it through one of the popular, rental providers these days, right? Those third-party renters out there, and you've rented it to 14 different people for each one of those days. Right? You're going to get that third-party provider is going to give you a 1099 for that.
Right.
And so what you do, the way that you work this, is that you are actually renting the business or renting the home out to your business, then the business is renting it to these people. And so that the business is going to expense that out because they were renting it from you. And then
Okay.
that's going to zero out the 1099 income.
Okay, but if it's some other kind of business, your barber shop, your print shop, your manufacturing company, your whatever business that you have, and you're using your home, so you're gonna have a business training meeting at the home and rent it for the day to provide that, it's your business renting the home. So your business would give the homeowner a 1099 for that rent, assuming that's, again, that it's over the $600 level.
So with your business, you really don't have to do a 1099 to yourself on that.
If it's a sole proprietorship.
That's the easiest way to do it. Is if it's a sole proprietorship and it's a disregarded entity and it's going to pass through, and that's the easiest way. However, you can still claim that expense on any of your other businesses that are going to be taxed the way that they're taxed. It's going to go under other rents on your 1040, or well, on the Schedule C, or sorry, I'm getting mixed up here. On the 1065, the 1120S, whatever the partnership return is, whatever the tax return is, it's going to go on there as other rents, which does not require the business to send out the 1099 miscellaneous.
So if I'm just renting an office from an office building, and I rent an office in that building, I don't have to give them a 1099 for my rent.
Correct.
And this is the same.
Right.
Okay. So why is it that some of the articles out there online say you better do the 1099 miscellaneous?
So they do that just for better accuracy in audit defense. The problem with it is when they're doing that, they're kind of getting themselves away from the exception that's in this rule. Right? They're creating a whole bunch of extra paperwork that could actually lead to them getting audited.
So they say it's income and then they expense it.
Yeah.
When it's really just not income.
Right.
In fact, if I've got a quote, a section of the quote here, it's section 280AG. It says, if a dwelling unit is used during the taxable year by the taxpayer as a residence, and such dwelling unit is actually rented for less than 15 days during the taxable year, then, the income derived from such use for the taxable year shall not be included in the gross income.
Correct.
So you just don't include it.
You just don't include it because it's not income.
So, okay, so the argument on the one side is, if you have the 1099 miscellaneous and then you expense it, you've got a record, and
Correct.
if the IRS looks at it with their magnifying glass, you can say, well, that's what I did see. Without that record, then you're just going to be quoting them this code section saying that's what I did.
Right, and then a lot of times that's actually what we're doing with the IRS and audits is we're quoting the code section that says we don't have to do that.
And I just say, and that's been my experience on many levels working with clients and others, that sometimes the IRS is not actually the expert on what the tax law says.
Correct.
Hence, some audits, the best defense is quoting the law and the facts that are in favor of the taxpayer.
Correct.
And that's why we have really smart tax attorneys on our team to help us do that sort of
Yeah.
thing. Okay, so this Augusta Rule, this is a good deal for homeowners and for business owners. And they just need to, look, I think if a business owner, as a business owner, I'm thinking, wow, okay, I should have 14 days out of the year that I, in fact, have a business event at my home. And in fact, document that, have a written agreement to rent my home, charge fair market rent. I can't just charge, a ridiculous amount. It has to be reasonable.
Has to be based on what it's renting for.
The going rate.
Yeah, the going rate. And there's actually really easy ways to do this. If you're using a third-party provider, use that third-party provider to see, when is the highest rate for this type of a home during the year. And then you can actually plan the days you're renting it out.
Oh, so then it might be to my advantage to have my business meeting at my home on the same day that a major sports event is occurring in my city.
Yes.
Okay, because that's going to be a high rent day. I could, in theory, rent it out to a third party, a stranger, and who knows what they would do on a sports event But if I have my own business there, I know what my employees are gonna do. They're not gonna get crazy drunk and trash the house.
Exactly.
That's always a risk with those sports events rentals anyway.
Right.
So who else is this good for? Is it, why do people use this or not use it?
To be honest, I think a lot of people actually don't use it, mainly just because they don't know about it, right? I think, and unfortunately, a lot of people name it as a loophole, which I really hate the word loophole when we talk about the tax law, because we never find loopholes. What we're finding is we just read the tax regulations in the code, and it's something given in the code. I mean, you read directly from the code, and the code said this is the law.
Right.
Right. And so what happens is a lot of people who have their different professionals, they're afraid to use loopholes.
Right.
And so a lot of people, this is
It's
very
not a
much,
loophole, it's just what the
Right.
law says.
yeah, this is just the law, and
Complying with the law.
a lot of people, I think, underuse it or don't use it. Generally, though, anybody who's got like a family office or a life coaching entity, or a family bank, or a residential LLC, all of those people would be prime candidates to be able to take advantage of this rule. I think anybody with one LLC should probably have a couple of them. And
So the complicated planning that we sometimes put our clients in is actually
Yeah.
creates some tax planning opportunities.
exactly.
To comply with the law, we
Mm-hmm.
don't want to break any rules, but there's planning opportunities in compliance with the law that can reduce the tax burden.
Right, and as we've been really saying this entire time, to maximize the use of this rule, it requires planning. You need to be able to know when is going to be the best time to rent it out, when's the highest fair market value on a daily rental, and you got to have some planning throughout the year to really maximize on it.
And then I guess it helps obviously to work with a tax professional who knows the rule, because if you take this to a tax preparer and they don't know the rule, they're going to say, oh, "What, are you crazy? You can't do that." And then as the taxpayer, you're in a pickle because you're trying to give tax advice to your tax preparer, and it should be the other way around.
Right, you're going to want to find somebody who, what they do is really they read and research the law so that they can best serve their clients, and they're not bound by any type of restrictive policies that aren't necessarily, illegal, right? I mean, for lack of better words, like the best
We've
accounting
always done it that
practices
way,
or generally
therefore,
accepted
yeah.
accounting practices, things like that, right? And where there's these strict policies on people who have limited licenses, you kind of, sometimes that doesn't really help the client themselves.
So what you're saying is sometimes a tax lawyer who is knowledgeable of the law can help taxpayers use the law to their advantage maybe more effectively than others who both don't know the law and don't have that same credential that a lawyer might have.
Yes, somebody like a tax lawyer, there are some other conditions that there's different professionals out there that are similar, but
Sure. So I'm thinking of a client that is a professional and that has clients fly into his city to receive professional services, and because the clients, it would be awkward or uncomfortable for them to stay in a hotel, he has them stay in his home. And so obviously a client's coming in for business purposes, they're conducting business, they're staying in his home, that would be someone that would be a good candidate for
Yes.
this type of thing.
yes, I think that's a great opportunity to say, okay, we're renting the home out to the business that is having the client come in.
Right, because they got to stay somewhere,
Right.
and staying in a nice home is better than renting a hotel. And
Yeah.
then you can chat over breakfast as you talk about the professional activities you're going to do that day, which is actually part of the business activity.
Correct.
Okay, so the Augusta Rule, Section 280AG of the tax code is a great opportunity for tax planning and a reason why you may want to consider talking with the tax attorneys at Durfee Law Group, where we would be pleased to help you. Thanks. That's it for today. Signing off.